Viraj Mehta of Equirus is here with us to chat about markets. Viraj, afternoon. Viraj, let's understand uh, from you on how are you analyzing the commentary of the big managements right now, be it HUL or even Bajaj Finance on the lending side. Does it give you a cause for a big concern, or you're observing things case by case closely?
No, sir. First of all, thanks a lot, Ajay, for having me on your show. So, I think those are two separate sectors to look at. I think how we think about lending sector, I think lending sector has done exceptionally well in terms of how their NPAs and how the collection has panned out for a lot of the large players. Even the larger players like Axis, ICICI has seen some resolution, including some of the larger steel players which got acquired by someone else. So I think the balance sheet of some of these players look very good. For somebody like Bajaj Finance, whatever write-off had to happen, they have taken more than 5% on the unsecured lending that they do. I think they're starting with a very clean slate going forward, and I think generally the results of all the NBFCs and larger NBFCs and larger banks have been reasonably good. So, and the commentary also is good. So don't see much issue there, except I think growth will be slightly more challenging. Except probably working capital, some of the capex driven growth may be delayed a little, which will mean that growth might be slightly challenging for some of the larger guys on the base that they're sitting in.
I would like to know from you, in fact, I've been posing that question to all my fund manager friends, how much probability would you assign, looking at the markers and indicators, reading the indicators, that the peak of inflation or worst of margin pressure could actually be made between this quarter and the next? Because margin pressure was seen 2-3 quarters back as well. It's not something new. It may have gotten accelerated. Do you think a peak will be formed between this quarter and next?
I'm very certain the peak in margin pressure will be in Q1. So if you look at the commentary of some of the larger FMCG players, and of course it can vary case to case, but a lot of the FMCG players actually had reasonable inventory starting January. So a large part of that hit was taken care because they had raw mat which was coming out of there. But Q1 will see probably the largest margin pressure that they've seen in last, I would say, 16 to 18 quarters. Should significantly ease out from Q2 onwards as we see some of the supply chain getting eased out, and we see price hikes being passed on over slight delay of a quarter or so. So Q1, you are absolutely right when you say that Q1 will probably be the worst margins across sectors. Wouldn't surprise me at all.
Yeah, there has been a lot of brisk buying in a lot of auto ancillary names last couple of days. This space was, up till now only select few stocks were doing well. Varick, of course, is a transaction which has happened, but barring that as well, many of them started perking up. Autos have come back very nicely. Is there a case to look at that space on valuations front, on risk reward front? Do you think worse is in the price and hence perhaps a case building?
I think we have to be extremely selective in auto because I agree to the larger point that you're making that auto, because of low base of last couple of years, CVs probably even more than that. You will have significant growth both in two-wheelers. Two-wheelers will be the first one to recover in our view due to rural recovery, due to high agri prices. That will happen. And you will have some of the larger players see sharper EPS improvement this year vis-a-vis what the street is expecting. But then it is more of a trade, especially in larger two-wheelers. It's not an investment per se. We see there is investment case actually in auto ancillary, which will not be disrupted by your EVs. Right? right? So you will have some of the segments like tires or some of more diversified auto ancillary players would be far more larger time horizon investment case than some of the larger OEMs, which may more or less be a trade.
Okay, Viraj, tell us, what have you been reading? What has been catching your attention couple of weeks? Areas which you have been focusing?
I can tell you what we have done in terms of portfolio changes over last couple of quarters. We have essentially added a logistics player, a surface express logistics player in our portfolio. There was a management change in that company when All Cargo took it over from the erstwhile management, and we see significant change in the earnings profile, and the new CEO has joined in, and we see that there will be significant market share gains for this erstwhile player, and which will mean that we'll see a lot of some larger players becoming larger and smaller players finding it very difficult to compete with larger guys in logistics play. So that looks very interesting to us. We also see there'll be significant traction in travel and tourism. So we have been owners of a casino and a hotel player for a couple of years now. We think the best time is still ahead of us. And we have added 2 snacking companies in our portfolio. I think both the snacking companies actually got really badly affected due to COVID and lockdowns, and the numbers are far worse than what they actually should be, but they're gaining market share. So we've added, as it's publicly known, Pratap Snacks as well in our portfolio. So we've added both 2 of snacking companies. The disclosure here should be that all of our clients, including myself and my family, we own significant investments in this company, and you should please consult your advisor before taking any investment action on this.
Let's understand the business models. Forget the stock price. For express delivery business and logistics, what kind of earnings growth, business growth, and then earnings, because operating costs tend to be very volatile with crude, etc. How do you see the trajectory of this business over 3 to 5 years on these 2 parameters?
So I think for the express logistics players that we own, today they are at 1,200 crore top line. The whole industry will grow between 15 and 17% over next couple of years. We think our player will be able to grow top line at between 18 and 22%. And the margin today, which is around 4%, should improve to double digit between 10 and 12% over next 2 years time frame. When that happens, you will see earnings growing from probably 40-50 crores normalized earnings to probably 180 to 200 crore normalized earnings over next 2.5 years. So there will be both top line growth, market share gain, and margin improvement for this particular player in the industry. As far as operating cost, you said, but in this industry, it's a significant pass-through. The industry has a fuel index that you have to track, and you can easily think about how much they'll be able to pass through, and a large portion of the fuel cost at least is a pass-through. There will be inflation in terms of labor cost, which they have to manage, which I think is more significant than just the fuel cost. But that as an industry is becoming less and less competitive because a lot of smaller players have gone out, and which is why we see 20 to 22% top line growth for the player and probably 15 to 17% growth for the industry as a whole.
Snacking, what's the growth lever here that triggers which should play out in the next coming quarters and years?
So, snacking industry has really gone through a lot of problems over last 2 years. So you had palm oil prices and laminate price go up significantly from 70-80 rupees to 120, and today they are even 130-40. And you had schools and manufacturing facilities, which are the major places where probably 30-35% of the sales come from, being closed. and which affected the sales growth as well. So on one side you had raw mat prices going up, and on the other side you had sales growth which was stagnated, or actually there was a decline in sales in those particular segments, which meant that your pricing power was affected. Now I think, and it may continue for a quarter or so, but what we are seeing is that early signs of the industry getting smaller and larger players being able to accommodate some pricing going forward will come back. You have the largest player which is unlisted in this industry, which is Balaji, today operating at 4% margin. I don't think that is going to sustain. And all of these players should go back to 10-11% margin over next couple of years. It will be a gradual drive towards that margin. But when that happens, the whole industry should get re-rated from 1.2 times sales to closer to 2.5 times sales. So how we think is that sales pressure is the worst is behind us, and the margin pressure should be the worst in Q1, and post that we should see significant improvement in both of these parameters. And today's stock price has a lot of value when you think that things will change 1Q onwards.
For a Friday, we are already talking about snacking companies. We could have talked about other beverage companies, alcoholic and non-alcoholic as well. But we perhaps leave it for some other time. Thanks. You're sitting in a dry state, so we won't talk about alcohol.
Absolutely.
All right, Viraj, take care.
Thank you
Thanks for
so
your
much,
input today.
Glenn.
That was Viraj Mehta
Yes,
talking about his portfolio bets and the way they are approaching markets. Time for a short break. On the other side.